Security financing is a type of financing that involves using securities, such as stocks or bonds, as collateral for a loan. This type of financing can be used by both individuals and businesses and can be a useful way to access capital when traditional lending options may not be available or when you want to avoid selling securities outright. There are several different types of security financing, including margin loans. Margin loans are a type of security financing where investors can borrow money to purchase securities. The securities themselves serve as collateral for the loan. Margin loans are typically used by investors who want to leverage their investments and potentially increase their returns. Securities-backed lines of credit. Securities-backed lines of credit are a type of loan that is secured by a portfolio of securities. This type of financing is often used by high-net-worth individuals or businesses that have substantial securities holdings but need cash for other purposes. Securities-based crowdfunding. Securities-based crowdfunding allows businesses to raise capital by selling securities, such as stocks or bonds, directly to investors. This type of financing can be an alternative to traditional bank loans or venture capital funding. Securitization. Securitization is a process where assets, such as loans or mortgages, are pooled together and sold to investors in the form of securities. The securities themselves are backed by the underlying assets, which serve as collateral for the loan. When considering security financing, it's important to weigh the risks and benefits carefully. While security financing can provide access to capital that may not be available through other means, it also involves putting your securities at risk. If you are unable to repay the loan, the lender may have the right to sell your securities to recoup their losses. Overall, security financing can be a useful tool for accessing capital and leveraging your securities holdings. However, it's important to carefully consider the risks and benefits before pursuing this type of financing, and to work with a trusted advisor or lender who can help you navigate the process. In addition to the types of security financing mentioned above, there are also some specific considerations to keep in mind when pursuing this type of financing. Loan-to-value ratio. Lenders will typically only lend a certain percentage of the value of the securities being used as collateral. This is known as the loan-to-value ratio, LTV. Depending on the lender and the type of securities being used as collateral, the LTV may range from 50% to 95%. Interest rates. The interest rates on security financing can vary widely depending on the lender, the type of securities being used as collateral, and other factors. Typically, margin loans and securities-backed lines of credit will have lower interest rates than unsecured loans, but the rates can still be higher than other types of financing. Margin calls. If the value of the securities being used as collateral falls below a certain level, the lender may issue a margin call, requiring the borrower to either deposit additional funds or sell some of the securities to bring the LTV back into line. This can be a risk for borrowers, especially in volatile markets. Eligible securities. Not all securities are eligible to be used as collateral for security financing. Generally, only publicly traded securities are eligible, and there may be restrictions on certain types of securities, such as penny stocks. When pursuing security financing, it's important to work with a reputable lender or advisor who can help you navigate the process and understand the risks and benefits. You should also carefully consider your own financial situation and goals to determine if security financing is the right choice for you. In terms of the advantages of security financing, some of the key benefits include access to capital. Security financing can provide a way to access capital that may not be available through other means, such as traditional bank loans or venture capital funding. Flexibility. With security financing, borrowers can often use the funds for a wide range of purposes, including investments, debt consolidation, or personal expenses. Lower interest rates. Depending on the type of security financing, borrowers may be able to obtain lower interest rates than they would with unsecured loans or credit cards. No need to sell securities. With security financing, borrowers can retain ownership of their securities while still accessing capital. This can be especially beneficial for investors who don't want to sell their securities outright. However, there are also some potential disadvantages to keep in mind. Some of the key risks of security financing include market risk. When using securities as collateral for a loan, borrowers are exposed to market risk. If the value of the securities declines, the borrower may be required to deposit additional funds or sell the securities to cover the loan. Interest rates and fees. While security financing can offer lower interest rates than unsecured loans, borrowers may still be subject to fees and charges that can add up over time. Potential loss of securities. If a borrower is unable to repay the loan, the lender may have the right to sell the securities to recoup their losses. This can result in the loss of valuable assets and may have tax implications as well. Overall, security financing can be a useful tool for accessing capital and leveraging securities holdings. However, it's important to carefully consider the risks and benefits before pursuing this type of financing, and to work with a trusted advisor or lender who can help you navigate the process.